All right, here we go. Good morning. It's 9 a.m. in Hong Kong, in Beijing, and in Shanghai. Welcome to Bloomberg Markets China Open. I'm David Ingles with Yvonne.
Our top stories this morning: a risk-off mood in Asia after Wall Street's worst Fed day in almost a year. Jay Powell now hosing down hopes of interest rate cuts beginning in March.
I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen.
Also ahead, Chinese stocks set to extend a record losing streak. The mainland benchmark wiping out all last week's gains on optimism over support measures. And the market rout also said to be triggering job cuts at UBS, axing about 90 positions in Asia private wealth and investment banking. So certainly there seems to be a lot of headwinds here across markets, but you got to talk about the Fed here. And I think the fact that the Fed Chair Jay Powell explicitly talking and playing down the prospect of a March cut certainly did lead to that's unwinding some of these dovish bets right now.
Yeah, we went from base case pretty much a few days ago to now. Obviously, that's a tail risk. It could still happen. There is still some pricing around a possible cut in March. But certainly what it's done, it's concentrated now those bets, Yvonne, into May, and even strengthened the case even for May and June, and maybe even July. We'll show you what that math looks like in a couple of minutes, couple of seconds. In fact, I'll just briefly give you a status report of these markets. So we're flat on A50 futures. We picked up, though, as you can see on U.S. futures, and that actually might be down to this news that broke about 20 minutes back on Moody's placing New York Community Bank Corp on watch negative, which could possibly mean that gets cut to junk over the next few months or so. Flip to boards, we have markets like Korea coming. Well, Korea's been up and running for about an hour or so, 0.7 to 1%. Exports just out about an hour back as well. Sign up momentum, if you will, as we start off this year. Bond markets, okay, here's ground zero for you. You have, well, your Chinese 10-year yield. You have an auction in Japan in Tokyo today. We're still some distance away from 2.3. That's the level you want to watch in the Chinese 10-year. That's your 2002 low, thereabouts. But given the sort of pace that we've seen on CGBs coming down, that's perhaps weeks, maybe months away. We have a Bank of England rate decision later today. We have a lot of central bank decisions to get through, of course, the Fed, and in between we had Chile, Colombia, and also Brazil, all cutting interest rates. I should note that. Commodity markets, very, very quickly. Here you go. At the bottom of your screen, you'll see, of course, the Shanghai contract coming online, about a 1% lower. And iron ore, well, I guess pick your contract. We're stabilizing, though, after what was a two-day drop as far as the Singapore contract was concerned. 0.3%. Okay, as promised here, more on the Fed. So before and after, right? This is the aggregate number of cuts or easing in basis points before and after the meeting. So 76 between March, May, June, and July. 4 meetings. That's now been up to about 85. So if you take out pretty much everything in March, that leaves you with about 2.5 cuts for May and actually June. So what the market's done, it's pushed it back, but it's now in many ways, based on the current information we have right now, cemented a cut in May and again in June. In case you missed it, too, so we're coming up a little bit right now as we start off in Tokyo, but we actually ended the session near lows after Jay Powell spoke. So high, we dropped back in, we came back up, and then reversed all of that, Yvonne, going into the close. So I don't know. Market interpretation may be dovish. We'll see.
Yeah, dovish, because I think the New York Community Bank stuff kind of, maybe changed a little bit of the view against the bond market in some ways. But really, it was what we heard from Jay Powell earlier than that, and rates are now likely at their peak. But, really pushing back when it comes to the possibility of March. Take a listen.
I think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, when you ask me about in the near term, right. I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case.
There you go, the good governor himself joining us here in set to unpack what I guess the key takeaways are from the Fed, what it means for markets. Aaron Brown, multi-asset strategy portfolio manager at Pimco, normally based in the U.S., has graced us with her presence this week. Thank you so much, and it's very nice to see you. You mentioned you were up at ungodly hours, like we were, of course, digesting the Fed. What was the most actionable bit, you think, from the statement or from the governor's presser there?
Sure. So I think there are three key takeaways. The first is that the Fed explicitly pushed back on March, and we're now really looking at a mid-year start to Fed cuts. The second, I think, is that the Fed really needs to see more confidence in the inflation trajectory. Certainly, there's been good progress, but wages in particular remain too hot. They're running at about 4%. It's probably about 1% over the Fed's comfort level. So we need to see that come back down lower. And then third, and interestingly, the Fed did discuss that they haven't yet discussed quantitative tightening tapering, but they're likely to do so and do a deep dive in the March meeting. And so that actually does mean that the time frame for tapering of QT is likely this year, in the latter part of this year. All of that said, as you mentioned, the Fed actually, or the forward pricing for interest rates really didn't move that much. In fact, if you look from 2 days ago to today, there's more rate cuts priced in between now and December year end than there was 2 days ago. I think a lot of that is on the back of what the bank action that we saw late in the day, particularly around New York Bank Corp, but Community Bank Corp. But I also think that with respect to the Fed, I think people right now are thinking that the timing is not going to be as important as the pace once the Fed does get underway. And so I think that's really a lot of the price action that we saw today. Going forward, I think that the yield curve is likely going to continue to steepen.
What do you think is going to be the actual thresholds, though, to give the Fed confidence that's ready to cut rates? Because that doesn't seem like it's very straightforward right now. Does that just leave the market hanging on every data print up until March?
I mean, the markets, the Fed is very data dependent, which means the market's going to be data dependent too. I think there's two key things. One, as I pointed to, is wages. We need to see consistent and persistent declines or disinflation in the wage growth number. Second, right now, a lot of the decline that we've seen in the inflation in the U.S. has been supply-side driven inflation coming lower. Yet demand is still really robust. Demand is running now above potential GDP. And so what we really need to see is that as the supply shocks continue to ebb and continue to fall, where really is inflation on a clean read, a clean print, and do we see inflation starting to move a little bit higher on the back of what is still a very robust U.S. economy?
So does it make sense to tilt one's portfolio towards somewhat of a global slowdown this year? How are you? I mean, do you time this thing? Because we know it's coming, although it's not quite clear as far as the U.S. is concerned. It's quite clear with Europe, for example, and China, too.
So it's very hard to time like the very front end of the fixed income curve. That's going to be highly volatile and very dependent on different data coming out. I think the number one trade to do is to be long curve steepeners in the 5s, 30s years point of the curve. Historically, we see when the Fed starts cutting rates, that's the time when the yield curve steepens. I think from an investor perspective, it is now time to start terming out your duration, going out of cash and into sort of medium term duration. I think the sweet spot of where you should be buying right now is probably the 5s and 7 years part of the curve. But I do think being overweight duration as the Fed starts cutting is going to make sense. I just wouldn't try to time the very front end part of the curve. Okay.
Much of last year, I think if you had to choose between bonds and stocks, people would choose the former. Do you think that trend continues for this year?
I do. I mean, if you think about historically, just given how cheap valuations are today, global ag is yielding close to 5%. In a historical context, that's about the 90th percentile in terms of cheapness. Certainly, there's going to be spots of equities that are going to do really well. Korea is a market in Asia right now that I think is really primed to do quite well on the back of the semiconductor cycle bottoming. But by and large, you're going to have a lot less volatility with really good returns, both on a carry perspective, a yield perspective, but also potential for capital appreciation in the fixed income market right now. And for most investors, that's a core portfolio holding that people should have.
Right. And I think correct me if I'm wrong, the last 2 years on fixed income, the profits on your book were mostly interest and not capital appreciation, right?
Yeah.
With all that being said, perhaps in the rearview mirror, how do I then think about high yield, for example, in the U.S.? And is 24 the year that finally breaks, or does that tighten even further in your view?
So high yield right now is incredibly expensive. Like I talked about how cheap sort of core fixed income is. High yield is about the 23rd percentile in terms of expensiveness based on a 10-year historical look back. It's really expensive right now. We saw significant spread tightening between October 31st and the end of the year. Right now, I'd rather buy equities than buy high yield. I don't think you're being compensated for the risk. You're buying a lower quality instrument with not much room for further tightening in terms of the spread. And you're really exposed to the left tail in case we do enter a recession.
I was going to ask you about New York Community Bank as well. Is this another SVB sort of situation? Do you think investors are sort of overlooking the stress that could be reemerging in the banking sector in the U.S.?
So I think in some ways it's easy to say that New York Community Bank Corp stands alone and that this is a problem that's really idiosyncratic to that bank. But I think that the problem arises that as we go through and see more and more of these idiosyncratic events pop up amongst the regional banks, that's a cause of concern. And I think, if you extrapolate what was already a concern, which is the commercial real estate market, and you look at the other banks that are exposed to commercial real estate, particularly in large urban centers like New York City, that's one of the reasons why you saw, some of these other regional banks today trade down 5-6%. And so I do think that coming into a year where you're going to start to see refinancing risks and refinancing rates for a commercial property loan have now doubled since the lows 2 years ago, that's a risk that you're going to see higher. It's going to start to drain earnings. So maybe you don't see defaults, but I do think it is a real risk for the market. And I do think that overall regional banks are going to be weak in the months ahead on the back of this news.
Got to ask you about China, this part of the world. I mean, you were in China this week, mainland China, of course. What's your sense as a visitor? How are things? And of course, as a foreign investor, how should foreign investors be looking at this market? You talked about cheapness, right? Like, that's
right there. Yeah.
That's right there, right?
Yeah, no, so China's certainly cheap on a valuation perspective, but I think that cheapness is likely warranted. I mean, I was just in China. I was really surprised in downtown Shanghai how little foot traffic I saw in many of their luxury retail stores and even just sort of the high street retail stores in the city, particularly ahead of the Chinese New Year. Certainly that's very anecdotal. I wouldn't, bet on that or invest certainly on that view. But our view is that Chinese growth is likely going to remain constrained just because of the challenges that we're seeing in the property sector. We're not expecting to see any type of large-scale stimulus. We'll likely see incremental monetary cuts, but they're going to be small. And what we really need to see is structural changes to really address the property market in China, and that's unlikely to occur. We haven't had the third plenum. The most recent meetings with the Politburo didn't address anything on the economy. Not that people were expecting to, but we're in a little bit of a void of information right now. And I think that that's a concern for investors. We think that growth is likely to be about the 5% range, but we think that that's likely a cap. And so that's our concern. It's that you're going to continue to see this lower economic growth environment, and there's just really not a lot of stimulus to excite investors and get capital flows back into the market.
Erin, it's great to have you here in Hong Kong. Erin Brown there, multi-asset strategy portfolio manager at Pimco. We're also taking a look at, we got through the Fed. BOE is actually coming up a little bit later on here today as well. You're not seeing a whole lot of movement in the Asia session here when it comes to FX, but how are they going to signal when the Bank of England is going to cut rates? Obviously, it seems like Andrew Bailey has suggested that they might have to follow the Fed and follow the ECB. But you look at the economic outlook, they're sharply, when it comes to inflation pressures are easing. You have the risk of the UK actually heading into a recession, David. You might have to see, how early those rate cuts are going to play out.
Yeah, and particularly that's a bit of a pickle because they've been extremely hawkish up until, I think, December, right? And inflation actually picked up.
Yeah.
I think it was last week or 2 weeks ago. Yeah, so we're not done, although we do seem exhausted at this point in time. It's Fed Day. Why not? All right, so we have the opening bell 15 minutes away here in Hong Kong, in Shenzhen, and in Shanghai. Welcome to Bloomberg Markets China Open, and good morning once again.
All right. We're all talking about milestones here today. This certainly is one that doesn't bode well. 6-month losing streak for the CSI 300 that was reached yesterday at the end of the month. That is a record. It's the longest losing streak that we've seen in the history of this benchmark. So certainly we see, all the gains that we saw last week on optimism, these support measures, that's been wiped out. HS Tech as well. We're still talking about 6-month steeply declines there as well. So, what's going to give? What's happening here? Why are we seeing this renewed selling pressure? Let's bring in Lanting Tu, our Asia Stocks managing editor. Yeah, so we knew that, what we heard last week, we're still waiting for confirmation of a stabilization fund. We still haven't got it. And investors are already giving up in some ways, Yanting.
Yeah, I think the lack of fresh catalyst or stimulus is really weighing on sentiment, and also economic data. The PM data was weaker. PMI data, I should say, was weaker than expected this week. So overall, we're just not seeing anything positive at the moment. And adding to that sort of pessimism is the news this morning that some companies are facing sort of the kind of renewed sort of margin calls, and then they have to top up their share pledges because they've taken out loans by pledging their shares, and now the market has been slumping. And so we saw an analyst note saying that 30% of Chinese companies may be facing this kind of collateral call right now. So that could add to sort of the vicious circle that we're seeing right now if they are forced to either close their positions or top up the shares. That's really not going to be sort of positive for the overall market as a whole.
Do you see any possible catalyst moving forward? Sorry, I'm a bit confused right now, but is there anything within the next 4 weeks outside of I guess, in-your-face blatant intervention in this market that could snap this cycle, at least provide a floor? Because we asked a question last week and we didn't get that floor.
Yeah, I think it's anyone's guess right now, right? As your guest earlier said, the latest Politburo meeting didn't mention the date or time for the plenum, and of course the March 2 sessions is something that people are really looking out for, and in the absence of any fresh stimulus, and people are looking at the kind of holiday spending that's coming up. And anecdotally, maybe when you go to shopping malls, there's not a lot of people buying, but some analysts are expecting the kind of experience-based spending, the kind of domestic travel going by train or domestic flights, that may pick up during the Chinese New Year period, and that potentially could give consumption or consumer stocks a little bit of a boost. But according to Morgan Stanley, I think they are saying that they expect, or they hope that the government could come out with a big consumer support package. That's something that a lot of other economists or analysts have been asking for as well, to really boost consumption.
Lanting Tu, our Asia Stocks managing editor in Singapore for us. Futures are pointing to a lower open, and that's probably what we're going to get. There we go, 0.25% to the downside. A full preview of your trading day ahead is next. This is Bloomberg.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
I do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. We don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
Right, big story. So we've learned that UBS is looking to cut about 90 jobs next month. That's across Asia private wealth and investment banking. That's amid, of course, a stock market rout in Greater China and a slump in deal making. Adam Haig, our finance editor, is with us right now to talk us through the details of what we know so far. So yeah, let's start with the cuts. Adam, what do we know about what's about to happen?
Well, David, what's really important about these cuts is where they're happening. So as you said, about 90 jobs looking to go, but crucially in private wealth, but also in investment banking. So on the private wealth side, of course, that's a function of the general kind of malaise that we're seeing in investment markets in mainland China. And of course, that's been a struggle that's been well televised. And so there's clearly a little bit of a pullback there. But also, of course, in investment banking, where deal flow has struggled, not just in kind of, the M&A side, but equity issuance, IPOs, and in the secondary market for equities as well. So you've got these two kind of things at play, which is, overall meaning that there's just less activity going on in those two areas. Now, there are bonus discussions going on at UBS this week, and so the numbers still could change if you get a number of people that will take more of a voluntary redundancy package post the bonus discussion. And so there are still some kinks to be ironed out in the next few days, but certainly this kind of a number looks like it's going to play out. Now, of course, UBS, it has historically a strong position in this part of the world, and with most of these cuts being in China and in Singapore in China-related roles, it really just shows you how much of a tough time even the strong big players are having over in this side of the world at the moment, given everything that's going on there.
Yeah, and as the chairman, Colm Kelleher, said, 2024 is where the challenging part starts in this integration as well, where some of the easy sort of job cuts that we saw last year, that's certainly coming to the end. The hard stuff comes now. Adam, thank you. Adam Haig, our finance editor, joining us on the latest when it comes to UBS. In terms of the day ahead, here's what we're looking at. Of course, looks like Hang Seng is edging to some gains here at the pre-market. So we're set to open higher, at least in Hong Kong. Potentially, hopefully, that reverses some of the weakness that we've seen in the last couple of sessions, where we basically have seen the CSI 300 on that record losing streak of 6 straight months of declines for that market. HS Tech, we're up 0.8%. So, potential we've been seeing with the Fed. Now, obviously, it was a little bit less hawkish, or more hawkish than expected, but I think the news of New York Community Bank certainly kind of reversed some of the moves that we saw in the bond market. Maybe that's a sign that the banking stress that we're seeing in regional firms in the U.S. could lead to the Fed to cut a little bit sooner than later. That's why maybe we're seeing tech catch a bid here this morning. In terms of analyst actions, we're watching the liquor makers as well. Anhui Guijing Distillery raised to a buy at Goldman, China Shenhua, China Galaxy Securities, those in focus. Yeah, on top of this, it's busy on data. So we're coming off the GDP print out of Hong Kong. Retail sales are coming out today. We have some data points out of Macau. 15, 20 minutes from now, the Caixin, these are manufacturing numbers are coming out. I can't talk today for some reason. And then the most importantly, I'd argue, is this finance ministry briefing at the top of the next hour. Plenty more ahead. This is Bloomberg.
Right, good morning. Welcome back to shows. It's funny what 7 days can do. 7 days is a week. Before you know it, it's Monday again. Before you know it, your hangover is still not done. And before you know it, some of the gains that we've seen, and in this case, the CSI 300, from the time of news of the state-backed support came in, we've reversed all of those gains, as you can see. That's also taking place in the Hang Seng Tech Index, and we're watching out for, it's not probably going to happen today, on the Hang Seng Index, which is still some distance away from those lows. We're still about 1%, and we are poised for a higher open today here.
Yep, so at least there's that. This is after we saw the CSI 300 in the longest losing streak on record, and that's despite some record inflows that we're seeing in some of these Chinese ETFs on speculation that there is a bit of state buying here, which is actually a few times more than what we saw back in 2015 as well.
More, yeah.
So you're certainly seeing signs of that. That's trying to put a floor on these markets. But then again, we were just talking to Lanting too about their team looking at more Chinese companies. Shareholders are adding collateral to their share pledges. There is this concern of margin calls now. Does that actually exacerbate some of the selling once we do see more of that? So there you go. HS Tech, though, is catching a bid here today. Obviously, we have to digest the Fed. So it was not March. That was what Jay Powell is signaling here. Unlikely when it comes to the first cut from the Fed here. You know, you're seeing more bets towards May now, but certainly in the last couple of hours, we have seen news of New York Community Bank, and that Moody's move that we saw on that regional bank here does lead to these banks to, well, I should try to say the bonds to rally. U.S. futures are also perking up as well. So does that mean this rate cut cycle could be pushed forward in some ways? So that's maybe why HS Tech is up. We're watching also very much so the developers. Was it the first top 100 developers? We saw January sales plunge more than 34%. Year on year, that was where we saw that. So developers are on offer here this morning. You're seeing consumers, staples, that's doing a little bit better, but the rest of the market still seeing quite a bit of pressure here this morning. Let's focus on the property names as well. So we talked about that data print. We also had the Caixin PMI due as well. So after that was a pretty mixed bag when it came to the official numbers. We're wondering if the Caixin private gauge shows any sort of clues. But those two have been diverging of late too, Dave, right? There you go. Property stocks still can't catch a break. Long Forest down some 2%. Sunac China also down 2.6% or so. We're watching the tech space, just given what we've been seeing in HS Tech. Yesterday was a steep drop of 3%. All right, Amer Sports, this is according to our sources, set to guide the IPO pricing below range at $13 a share. So that's sending Antisports down some 7% here today. Watching wuxi XDC, profit increase of over 80% year on year for last year. Given just all the news flow with wuxi, we had to check that as well. And CATL. So Tesla set to open, according to our sources, a U.S. battery plant with equipment from China's CATL. We saw a big pop in the shares yesterday, but certainly now coming off that just a little bit there, Dave.
There's so much corporate news, and
I know.
Before you know it, we enter earnings.
I went a bit too long, didn't I? Sorry, producers.
No, but I think the wuxi is very interesting too, right? Because of all the gyrations that's taken place. Yeah. We were not supposed to be talking about property, but yeah, the sales came through as well, and further downside there. In terms of further downside, so we've been tracking this rally in CGBs for many, many weeks now, and at these levels, we're now flirting with 2.4%. We're not very far from that low we hit back in 2002 of 2.3% thereabouts, and this is a completely different economy than what it looked back in 2002. Yet here we are on the back of rate cut expectations and the slowing economy. When do things improve, I guess, is the question.
Yeah, let's bring in Wang Shenzhu and ask him that very question, Chief Economist and Global Head of Asset Management at Haitong International. Do you see any signs of improvement in the next few weeks or months?
Thanks for having me. Currently, definitely, we think that China is the growth is below trend due to the deflation pressures on both CPI and the PPI deflation. So that's why we think they need to be aggressive aggregate demand policy to support demand and to reverse the cycle of deflation, in particular the pressure on the PPI, because that's matters for corporates' earning forecast, and everyone is lower their forecast guidance. So that's a pressure on the corporate earnings side and on the corporate sales side. Yeah.
So how long do we wait? You talked about PPI earlier on. Do I look at 2013 to 2016? That's a very long time.
Right. In the previous episode of PPI deflation even lasts for 48 months from 2012 to 2016.
There we go.
But at that time, it's different because that time China launched the so-called supply-side reform. It's because the PPI deflation in the previous episode was due to overcapacity because of the also the inventory and other factors. But this time it's different. There's no obviously overcapacity issue. So that's why we believe they need to be an aggregate demand policy. For example, tax cuts, further rate cuts, increased government spending, and increased subsidy even to the consumers to bring back the demand cycle.
Do you still get a sense that this is policymakers that are still prioritizing growth right now, or what we've seen so far just reactive measures to what
That's
markets
a very
are
good
pricing?
question. There are both cyclical and long-term structural factors. From structural economic growth, China is slowing down with the lower growth trend. That's due to the population aging and other switch to a high-quality growth model, which is natural. But cyclically, the thing worries me is more on the short-term side, on the PPI deflation, as I mentioned, because so that's why we also need both cyclical demand policy to reverse this cycle, because that matters for people's expectations.
Right.
We think the authorities need to acknowledge the pressure on deflation and bring on the table more convincingly or more decisively the easing policies.
Is the window closing from this becoming a Japan in
No.
the 90s? Because I think that's partly where this might lead to as well. And,
Right.
we don't want to get caught in. It was very difficult for Japan to get out of that.
Yeah, but Japan also has a different case with China. Japan has no capital controls. Basically, Japanese corporates, after the collapse of the housing market in the early 90s,
Right.
they increased ODI to invest overseas. And for Chinese firms, this could be an opportunity to further diversify their investment along their supply chains. For example, in the Southeast Asia, in the Middle East, in the Belt and Road countries. So that's why they can bring more the corporate revenue from overseas. That's what Japanese firms did.
So what does this mean for markets, for stocks? I mean, it seems like we're seeing much more of this renewed selling now. How much more downside could we see for stocks?
Last year, when I was here, similar times, when I discussed the 2023 outlook, I used the keyword mediocre, which happened because for Asian investors, on one hand, they gained on U.S. equities and advanced market equities, but also they suffer a loss on Great China equities. So that's why we emphasize the importance of multi-asset allocation. And in general, when the inflation is trending up or nominal GDP growth is high, we should tilt to equities. But in the current environment, we just see the CGB bond yield keep falling, which onshore the China bond market is having a rally right now. So that's why we emphasize the asset allocation instead of focusing too much on the equity market alone.
Yeah.
Same for the U.S. market.
So talk to us about fixed income then, in your view. I mean, particularly when it comes to CGBs and as a Chinese firm, for example, is it actually easy to sell? Exposure to CGBs to dollar investors, for example?
Now they have both the southbound, the Bond Connect, southbound and northbound, and also they have the interbank trading market for the bond investors. Yeah. So I believe there's a channel even for foreign firms based in Hong Kong. We can do the investments through either QFII or Bond Connect.
So you're saying 2024 is one word, the year of promising, right? I mean, lay it out for us if you think it's something that you're tilting more towards bonds, I guess, over stocks. Why? What's the assumption there?
Yeah. When the inflation is trending down in both U.S. and China, so naturally you should overweight the duration. You should overweight because the yield curve is steepening.
Right.
Also, last night at the FOMC minutes, the Fed gave some disappointment to the market that there will be a rate cut in March. but he didn't say mid of the year or May or June. So our base case, or many market participants believe, there's still the beginning of the rate cuts sometime this year, which the beginning of the new monetary and policy cycle. It seems to me China is more negatively affected by the interest rate differential or the interest rate overhang than any other factors, because for China or for Asian investors, basically the risk-free return is too high, and it curbs investment.
That's interesting. I think you're the first person that said that the Fed is more important to Chinese markets than the domestic issues.
Yeah, because you see in the past few days, with Trump winning 2 states in the GOP primary, the market even started to bet a second trade war. But to me, China is more negatively affected by the interest rate overhang even than the trade war.
Okay. Well, do things improve? Rates are going to fall. Is now the low point of the year for equity markets?
Yeah, I understand, but I also use the word of patience, because back to 2016, similar time this year, in January 2016, after China's stock market crash, and there's 2 circuit breakers, and also the CSRC chairman just stepped down in January 2016. But after around 3 quarters, in the second half of the year, China economy start to stabilize, and inflation are coming back, which there's a reversal of the market sentiment. So it takes time for the demand side policy, for the easing policy to be effective.
Chengzi Wang, thank you so much. It's nice to see you.
Nice to see you.
And maybe in 12 months' time, things are better. Okay. Chief Economist, Global Head of Asset Management at Haitong International. Breaking news here.
In the last couple of minutes, we just heard from the U.S. House passing a $78 billion business and child tax break bill. That's going to provide a potential boost here for U.S. companies and some of these large capital and domestic research expenditures, and really hand Joe Biden election year political victory. So that's certainly what we're watching out here. That measure was approved by a vote of 357 to 70. So that certainly was a big majority there. And that now heads to the Senate, where we'll see how Republicans look at this sort of legislation. We have plenty more ahead. This is Bloomberg.
Okay, welcome back. Now, sources are saying here that Amer Sports has raised, get this, $1.3 billion in a U.S. IPO, priced actually below the marketed range, and the second, of course, major IPO in a week to miss its target. For more on this deal and the implications, let's bring in Felipe Pacheco, our Bloomberg Equity Capital Markets reporter, to talk us through the main takeaway from the final pricing, which came in softer.
That's correct, David. Well, a lot of things that we can take from this IPO that are quite interesting. One of them, of course, the price. The shares were sold at $13. The bottom of the range was $16. The top was $18. So you can have an idea that actually people were not willing to buy it at the level that the bankers and the company were selling them for. What we know that this was delayed by 1 day. The pricing was delayed. There was some conversation in the market that there could be some sort of pressure regarding valuation in the moment of the market. Even those stocks in the U.S. are doing quite well, as we know. So this is a moment that it's a company that is somehow tied to China. It's backed by what the biggest shareholder was the one on top of the consortium that actually bought a big stake back in 2019. So there are a lot of elements there that people were basically asking, is this going to open the doors for more U.S. IPOs and for Chinese names in New York? I think it's still very hard to say if this door will be open.
Yeah, that's why we're seeing Anta shares down some 5%, potentially because of the story, because they are part of that consortium. But yeah, this company, though, we have to talk about what they do, right? They make what? Yeah. Arterex, Wilson rackets, Solomon ski boots. Yeah.
Nothing I use, but yeah. Not relevant, but
But for those who didn't know, Amer, they do all that. But I mean, I'm just wondering, in terms of the backers of this IPO, what do we know right now?
That's right, Yvonne. Like, it's a very interesting company because it's actually a Finnish name, European, traditional products. A lot of people in many different markets do recognize them without necessarily knowing the name of the company.
Yeah.
But at the same time, this Chinese consortium that led by Anta, which is a big name in the Chinese market, that also includes Tencent, and also the fund by the backer of Lululemon Athletica. These guys were all together backing this IPO, and they actually, what our reporters in New York showed in their reporting, is that they were actually buying more shares than they were initially expecting in the IPO, probably to support this deal, to actually make it go through and not have to be pulled all the way through. So these are important names, these are big backers, this is the way it's related to China and to the Chinese market. And that reaction that you just mentioned in the mainland today is a clear indication that, of course, nobody wants to price an IPO below the bottom of the range. That's not good news.
Yep. All right. Definitely a bit of disappointment there. Felipe, thank you so much for bringing that scoop there. Felipe Pacheco, he is our equity capital markets reporter on the latest on Amer. And we're going to hear more from Amer Sports CEO James Deng later on from the New York Stock Exchange. It's going to be coming at your times on your screen right there.
Okay, Caixin manufacturing PMI for January out. Estimate was for 50.8. And bang in line. Good estimates, 15.8 as well. And coming in, and you don't typically get a lot of forecasts as much as you get on the official numbers, but this one coming in slightly on the higher end of at least the median, at least as far as the range is concerned. But consider that matching expectations.
Yeah, and in some ways also, once again, very different from the official numbers, which was a fourth month of contraction. So I think Bloomberg Economics has told us that, kind of don't really care about the private gauge a little bit. There's a bit of not really, reflecting the true nature of what we're seeing in the manufacturing floors, but certainly at least we're seeing a 50.8 print here today. We're watching some of these, chip stocks in focus a little bit more here today. Obviously, we've been talking about AMD and what happened with their earnings. So it's a mixed bag, but TSMC is down some 1% in Taipei. Samsung, on the flip side, is up 1% here today. And we're talking about AMD real closely and what happened overnight.
Yeah, we paired some of the losses going into the close, and certainly there's optimism about these new AI processors helping investors at least look past at least the most immediate downbeat forecast for the first quarter. And the CEO, Lisa Su, also told us that the market is in the early stages of a huge expansion. Have a look.
When I look at the potential of AI, it is really the single most important technology innovation over the last 50 years. So AI has so much potential to change the way our businesses work, to change our personal productivity, to really change the way we do research and a whole bunch of things. From our standpoint, we see the AI TAM growing to upwards of $400 billion by 2027. I think from an AMD standpoint, you were at our launch, Ed, in December. It was a great coming out party for the AMD, AI capabilities, and it's gone really well. I think our customer interactions, our product qualifications, our ramp have gone really well. So we were able to update, some of our numbers this past week.
I think a lot of folks focused on that ramp and how it went in the quarter. You exceeded the 400 million that you told me about at that event. So it's $3.5 billion of sales this year for MI300. What's interesting here is kind of your ramp relative to what's happening on the supply side. And I wondered how big a factor supply will be in matching or beating that number in 24.
Yeah, absolutely, Ed. This is the fastest product ramp, in our history. So, we exceeded our numbers in Q4, over 400 million. We're going to grow into Q1, and we updated our full year forecast from 2 billion to 3.5 billion. The way we think about that is that's a customer demand statement. So that is customers that we've engaged in, who have made commitments to us, who have placed orders with us. We're planning for a much larger number as it relates to the supply chain. This is what we should do. We always plan for success. So, my view is it's still very, very early in the innings for AI AI accelerators, and particularly for MI300. But this is an opportunity for us to continue to build a major growth driver as we work with our top customers on their AI plans.
AMD Chair and CEO Lisa Su speaking to Bloomberg Technology co-host Ed Ludlow there. Some other tech stories that we're following for you today. The leaders of top social media platforms have faced a barrage of criticism from U.S. lawmakers over their online child safety failures. The CEOs of firms including Meta and X testified before a Senate committee on Wednesday and were pressed to support new legislations to impose controls.
Social media companies, as they are currently designed and operate, are dangerous products. Mr. Zuckerberg, you and the companies before us, I know you don't mean it to be so, but you have blood on your hands. You have a product. You have a product that's killing people. These companies must be reined in, or the worst is yet to come.
The CEO of Singtel Digital InfraCo, Bill Chang, says demand for AI data centers in Asia is only in its early stages. He was speaking to us after the company launched a new data center brand, which includes a collaboration with NVIDIA.
We believe, given what NVIDIA's projections and, a number of the reports, this is a trend that is in the early cycle of the whole sort of AI adoption trend, and there's going to be growth that's coming. And at this stage, we've just taken a very market demand-driven kind of view to stage this as we expand and bring those AI DCs in, out to the market in phases.
Okay, and we have a big one coming up. Suffice to say, Jensen Huang joins us at those times to join us, of course, for that exclusive conversation. Yeah, guess there's lots to talk about with him. Plenty more ahead. This is Bloomberg. Okay, so massive drop in shares of Japanese bank Aozora. We're down by effectively what the stock is allowed to move to the downside, so down by the daily limit on the back of some forecasts here as far as their exposure to U.S. commercial real estate is concerned. And this theme is really cutting through many parts of this market today. This is really one part. And earlier on, we had that headline, massive headline out of Moody's on New York Community Bank Corp. Yeah,
it's interesting that this is all coming back, right? And if you take a look at what really led to that record drop in New York Community Bank, provision for credit losses was more than 10 times what analysts were expecting here. So, I mean, it just goes to show that there's still a lot that we don't know about banks' exposure to the real estate side of things. So certainly, maybe that's why we're seeing U.S. futures perk up. We're still up about a fifth. Good news? Yeah, bad news is good news. Maybe the Fed needs to start looking at this very closely. I think Ben Emmons was talking about in his note the fact, in the statement, they took out that line from the Fed that the banking system is sound and resilient, but not even one question was asked during the presser about possible stress in the banking sector.
Well, markets are asking questions now, aren't they? There we go. We're headed into the next hour, of course, at Bloomberg Markets. Markets looking like this. And top of the next hour, we're looking at a briefing out of the Chinese Finance Ministry. Brace for that and others. This is Bloomberg.